Hello students, Assalamu alaikum. Today the topic we are going to discuss is ratio analysis. Ratio analysis is a very important topic because every year it comes in your exams, especially in O levels. Every year it comes in MCQs also. So I've tried my level best today to explain you how to do ratio analysis. So let's see the question. Okay. Okay, here is your question. Okay. Now you have to calculate, first we have to calculate liquidity ratios. Achha, in your O levels, A levels, there are two types of liquidity ratios only. Okay. Number one is current ratio. Current ratio. And the formula is current assets, okay, divided by current liabilities. Okay. So this is the formula of current ratio. Getting my point clear? Okay, current asset divided by current liabilities is your current ratio. So in that question, what we do, we have to calculate first the current assets. Okay. Okay. Now, so current ratio is equal to current assets. Current assets, we have cash at bank and hand, 80,000. Plus stock or inventory, 15,000. Plus receivable and debtors, that is 28,000. Okay, cash in hand stock. Stock means now it is called inventory. Okay, previously it was called stock. Inventory. Okay, debtors. Now it is called trade receivables. Creditors, bank overdraft. This is prepaid insurance. This is rent owing. Okay. So now, after trade receivable, we have prepaid insurance are current asset. Okay. All prepaids are current assets, so we can write it here 7,000. Got it? Now, current liabilities we have here creditors 19,000. Creditors, now it is called trade payables. Okay, that is 19,000. Okay. That is 19,000. Bank overdraft 5,000. Okay. Then rent owing, other payables 2,000. So this is our current asset and this is our current liabilities. So that would current assets. Now total current assets would be 80,000 plus 15,000 plus 28,000 plus 7,000. So total current asset would be 130,000. Okay, what about current liabilities? 19,000 plus 5,000 plus 2,000. So that would make your current assets, current liabilities 26,000. 26,000. Got it? Okay. Now, what would be? Now, what would be the answer? 130,000 divided by 26,000. Answer is 5:1. 5 ratio 1. This is your current ratio. Achha, what is the satisfactory current ratio? What would if your answer comes 2:1? 2:1 is satisfactory. But this answer is above than satisfactory level, but we can say good, very good level, 5:1. Okay. Now, second liquidity ratio we have in our CIE is quick ratio. Quick ratio is also called sometimes acid test ratio. Okay. Now, acid test ratio is equal to quick acids, okay, divided by current liabilities. Getting my point clear? So we should know what are quick acids. Okay. Now, quick acid means current assets minus stock or inventory, whatever you call it. Okay. This is called quick assets. Getting my point clear? Okay. Now divided by current liabilities. Now, in that case, in this case, what will happen? Our current assets are 130,000 minus our inventory 15,000. Okay, divided by our current liabilities, that is 26,000. So this is how we calculate quick ratio. Got it? So the answer would be 130,000 minus 15,000 is equal to 115,000 divided by 26,000. The answer is 4.42 ratio 1. Okay, 4.42 ratio 1. Now, for quick ratio, the satisfactory level is 1:1. It's satisfactory. Are you getting my point clear? Getting my point clear? Okay. Now, so these are two liquidity ratios we have in our CIE, both liquidity ratios. We have, this is the formula of current ratio, don't forget that. Okay, and this is the formula of quick ratio. Got it? Okay, now next item. Our next item, the next topic today, after liquidity ratios, we will do efficiency ratios. Okay, are you getting my point clear? So what we have to do? We have to do efficiency ratios. Now, efficiency ratios we have. Okay. Okay. The first is rate of inventory turnover. The first uh, is inventory rate of inventory turnover, and okay. Now inventory turnover is calculated by how? Is calculated cost of sales, okay, divided by, okay, cost of sales divided by average inventory. Okay. Now this is a formula, cost of sales divided by average inventory. Okay. Now we know cost of sales, how to calculate cost of sales. Cost of sales, we all know how to calculate. Formula I'm repeating. Inventory, I always forget inventory at start of the year plus purchases minus purchase returns plus carriage inward minus inventory at, this is the formula of cost of sales. Okay. Now, if we have to calculate rate of inventory turnover, we should know what is the amount of cost of sales. Now, in this question, Kilmers, we are given revenue, both inventories, opening inventory, closing inventory, payables, receivables, non-current assets, long-term liabilities. No, cost of sales is not given, so it's not difficult to calculate cost of sales. How? The gross profit to sales ratio is 20%. It means out of revenue 120,000, 20% is profit. It means 80% is your cost. 120,000 multiplied by 80%, 96,000 is your cost of sales. Now in this question, it's very easy to calculate because you can use profitability formula. Gross profit is 20%. It means cost is 80% of sales. So we can easily calculate your in this question. Acha. Now cost of sales. Now we have calculated cost of sales. So in this question, we have calculated cost of sales without using this formula. We have calculated directly by using sales 120,000 sales figure multiplied by 80%. And that is 96,000 is your cost of sale in this question. Okay. Now, second thing we have to calculate average inventory. Okay. Now, average inventory, we have to calculate by inventory at start plus inventory at end. Okay, divided by 2. Divided by 2. Now, see. Okay. Now, in this question, we have okay. Now we have inventory at start is given. Yes. 1st April 2011, 22,500. 22,500 is inventory start plus inventory at end. 26,500 inventory at end, 26,500 inventory on 31st March 2012, 26,500. Okay, divided by 2. So now see. So what would be so what would be the answer? Average inventory 22,500 plus 26,500 divided by 2, 24,500 is your average inventory. Got it? This is your average inventory. Got it? Now you have cost of sales 96,000, your average inventory is 24,500. Now you can easily calculate inventory turnover, rate of inventory turnover, not inventory turnover, rate of inventory. Rate of inventory turnover. Now cost of sales 96,000. Divided by average inventory 24,500. Got it? So what would be the answer then? $96,000 divided by 24,500. Answer is 3.92 times. 3.92. Got it? This is rate of inventory turnover. Now, second thing in efficiency ratios. So first we have calculated rate of inventory turnover. Suppose they ask you to calculate inventory turnover in days, not in rate of inventory turnover only. Inventory turnover. So what you have to do, it's very easy now. 365, okay, divided by 365, okay, divided by 3.92. 3.92. Getting my point clear? 365 divided by 3.92. How many days in a year? 365. What is your rate of inventory turnover? 3.92. And you will get the answer. 365 divided by 3.92. That is 93.11, or you can write it over here. No, go down. That is 91 days. No, sorry, 93 days. 93 days you have to keep the inventory with you. Okay, whatever the goods you are buying and selling, these goods will remain with you for 93 days. This is inventory turnover. Got it? Rate of inventory turnover, and second is, this is second, inventory turnover. Okay. Now, 3. Okay, this is making 2. Okay. Now, number 2. Number 1 was in rate of inventory turnover and inventory turnover in days. Now, some number second efficiency ratio is you have trade receivables turnover. Trade receivables turnover. So the formula is trade receivable at the end of the year. Okay, divided by, okay, trade receivable at the end of the year, इधर आएगा multiply by 365 and here. Net credit sales. Okay, not cash sales. Please be careful about that. What students can make mistake, because receivable turnover is a term which is linked with net credit sales, not the total sales, not with the cash sales, only net credit sales. Okay, now in this question we are not giving it this sales is on credit or not. So what we can do, you will find a cash sale. Okay, this is statement. all sales and purchases on credit. All sales and purchases are made on credit basis. Made on. Okay. Done. Now it means this the total sale is credit sale 120,000. Oh, easy ho gaya. Okay. Now how to how to calculate trade receivable turnover? Okay. Trade receivable is how much at the end of the year? Trade receivable, yes, this is here, 36,000. Receivable turnover. Receivable turnover is 36,000. Got it? 36,000 and sales is this total sales is net credit sales also because we don't deal in cash sales. Okay, so trade receivable is 36,000. Okay, multiply by 365. Okay, divided by net credit sales. And net credit sale was 120,000. Okay, so the answer would come in days. So 36,000 multiplied by 365 divided by 100. 36,000 multiplied by 365 divided by 120,000. Answer is 109.5 days. Almost 110 days. Oh my God. So it means 110 days. It means to recover your amount, it takes 110 days, almost 4 months. Almost 4 months. It takes you to collect money from your credit customer. This is not a good situation. Okay. Okay, next. Next is payables turnover. Payables turnover. So, how to calculate trade payables at the end of the year? Multiply by 365 divided by net purchases, net credit purchases, sorry, not cash, net credit purchases. Be careful about that. Okay. Now in this question, net trade payables is how much? Trade payables at the end of the year is 24,000. Got it? Okay. Okay. And credit purchases are not given here in the question. Got it? So what to do? We have to calculate credit purchases or total purchases because total purchases is on credit also. So we have to calculate first net credit purchases. So what we do, we'll write here the formula. Cost. क्या था हमारा cost of sales का formula? That was this is the formula. This formula will help us to calculate cost purchases. Okay. Okay, I'm writing it over here. Paste. Okay. Now cost of sales, we know that is 96,000 is equal to inventory at start 22,500. Okay, 22,500 plus purchases we have to know, so we'll write purchases over here. Purchase returns is not given, so we are going to we are deleting purchase returns. Okay, carriage inward is also not given, so we'll putting it as 0 again. Okay, minus inventory at end. Inventory at end is given 26,500 minus 26,500. Now you can easily calculate purchases. Okay, so the purchases would be equal to purchases would be equal to 96,000 plus 26,500 minus 22,500. So what will be the amount of purchases then? 96,000 plus 26,500 minus 22,500. Answer is 100,000 is your purchases. So purchase is there. And all purchases are made on credit. So this is the total purchases, also your net credit purchases. Okay. Because returns is not given. Now we can easily calculate payables turnover now. So payables turnover would be how much? Trade payables at the end of the year. Trade payables at the end of the year is 24,000. Yes, 24,000. 24,000 multiplied by 365. Okay, divided by net credit purchases 100,000. Getting my point clear? This is payables turnover. Control. Okay. So what would be the answer? The answer would be 24,000 multiplied by 365 divided by 100,000. Answer is 87.6, almost 88 days. So you take 88 days to pay off, almost 3 months you take to pay off your liabilities. So delaying tactic of liability is good. It's good. Okay, you are not paying very early. But when you are not paying early, it means you are losing. You might be losing your purchase discount as well. Okay, or discount receipt. Okay. Now the last in efficiency ratio is non-current asset turnover. Non-current asset turnover. The last in your efficiency ratios. This is your liquidity ratios and this is your efficiency ratios. Okay. This is your efficiency ratios. I forgot to give the efficiency ratios. Getting my point clear? So this is your efficiency ratio. Okay. Now one is rate of inventory turnover. Then inventory turnover is part of rate of inventory turnover, receivable turnover, payable turnover, and the last is in your efficiency ratio. That is non-current asset turnover, the last one. Non-current asset turnover. Non-current asset turnover is equal to net revenues divided by total net book value of non-current asset. Net revenues divided by net book value of non-current assets. Got it? So net revenues means sales minus sales returns. Okay. So we do not have sales return in this question. So total revenue is your net revenue also $120,000. $120,000 divided by book value of non-current assets. Yeah, here is the value of net book value of non-current asset. That is 2,40,000. So here by $240,000. Got it? Getting my point clear? So that would be 120,000 divided by 240,000. The answer is 0.5. Answer is 0.5. So with that 0.5 means 50%. That's good. But normally as its percentage or its value increases, it means the company's efficiency is increasing. Are you getting my point, Claire? So these are this non-current asset turnover is not included in O levels. Okay, this is not included. This is not included in O levels. Okay, for O levels we have these three formulas in efficiency ratios. These three formulas. The fourth one, non-current asset, is in A levels, not in O levels. Okay. Okay, these two liquidity ratios are in O and A both levels. Getting my point clear? So that's all for today, inshallah. Tomorrow we'll come up with more ratios, inshallah. So take care. Subscribe my channel. Allah Hafiz. If you want me to solve something special for you, leave a comment. Thank you. Allah Hafiz.